Hey everyone, welcome back to Gold Rush Reporter. I'm your host, your trusted gold and silver analyst, here to break down the real stories that mainstream financial media won't talk about. If you're serious about understanding where global money, metals, and markets are heading, stick around because today's discussion could change how you think about hedging, currencies, and precious metals. Right now, investors across the world are asking the same question. How do you protect yourself if the global economy turns south? We're talking about a scenario that could look even worse than 2008, with a deflationary shock, market panic, and collapsing trust in government debt. Should smart investors hedge with US bonds? Or is gold and silver still the only true safe haven left? Let's dig into that. At the New Orleans Investment Conference, one of the sharpest debates among analysts focused exactly on this issue. Some investors suggested holding a small position, maybe 5 to 10%, in long-term US government bonds as a defensive hedge. The logic is simple. If deflation hits hard, bonds could rise in value as interest rates fall. But here's where the situation gets dangerous. Many seasoned analysts now see bonds as a potential trap. America's credit reputation has taken another hit, and the US government's spending is out of control. No one in Washington seems capable of tightening fiscal policy, and that's not a temporary issue. That's a structural weakness in the system. So while bonds once looked like a safe refuge, today they're starting to resemble a ticking time bomb. Investors are slowly realizing that the promise of safety in government debt might just be an illusion. And that brings us to something more fundamental. People used to tell me, don't invest more than 10% of your portfolio in gold. It's too volatile. I ignored that advice completely. Back in the early 2000s, when everyone was chasing tech stocks and fiat profits, I went all in on gold and silver because I understood the fundamentals. For nearly 15 years, precious metals were my only investment, and they outperformed every major asset class in that period. That wasn't luck. That was logic. Fiat currencies lose value as governments print money and central banks manipulate interest rates. Gold and silver, on the other hand, hold purchasing power across decades and even centuries. They don't depend on anyone's credibility to retain value. So when people ask whether they should hedge with bonds, my answer is simple. A small hedge is fine if it helps you sleep at night, but don't kid yourself. The real hedge isn't in paper promises. It's in hard assets. Gold and silver remain the ultimate insurance policy against the collapse of faith in the entire financial system. And right now, the cracks in that system are starting to show. Now, let's take this discussion a step further. A lot of foreign investors, especially from countries like Australia, are trying to figure out how to balance their portfolios while still protecting themselves from the US dollar's volatility. The question that keeps coming up is simple. If you're an international investor, should you hedge your exposure when buying long-term US, government bonds, or ETFs like TLT? The logic seems sound on the surface. By hedging your currency, you're supposedly protecting yourself from exchange rate swings if the US dollar weakens. But here's the real problem. Most people are missing the bigger picture. Even if you hedge your currency risk, you're still exposed to the deeper issue of systemic debt and monetary decay. Central banks are stuck in a cycle of endless stimulus, and no matter how clever your hedge looks on paper, it won't shield you from that fundamental rot. When you zoom out, the relationship between the US dollar and currencies like the Australian dollar gets even more interesting. Not too long ago, the Aussie dollar was pegged to the US dollar. But now, both currencies are sinking, just at different speeds. It's like a group of skydivers jumping from a plane. They're all falling, but one might drop faster than another. The plane in this case is gold, the only thing not falling. Every fiat currency in the world is losing value relative to gold and silver. Some just do it quietly, while others crash spectacularly. So when people talk about hedging, what they're really doing is rearranging chairs on a sinking ship. Sure, a hedge might soften the blow if the dollar crashes, but it won't change the fact that the ship itself, the fiat system, is taking on water. If you're thinking long term, the smartest move isn't just about managing exchange rates. It's about owning assets that don't depend on them in the first place. Now, it's worth noting that the Australian dollar, despite its recent weakness, has historically performed well during commodity booms. That's because Australia is resource rich. It has gold, silver, uranium, and a range of base metals. But here's the catch. Government regulations and bureaucratic limits have prevented Australia from fully capitalizing on its potential. They've got the resources, but not the political will to leverage them effectively. In a world where inflation keeps rising and commodities become scarcer, the Aussie dollar might see short bursts of strength. But don't confuse that with long-term stability. When global demand for basic metals like copper and aluminum drops, as it tends to do in economic downturns, currencies tied to those exports will weaken again. So if you're an investor sitting in Australia, thinking about whether to hedge your bond exposure, the real question isn't, should I hedge? The question is, what am I actually protecting myself from? Because if what you fear is a collapse in trust, in currencies, and in central bank competence, then you need more than a paper hedge. You need hard historical protection. And that protection has always been, and still is, gold and silver. As we move deeper into this discussion, let's look at what's actually happening behind the scenes. The global economic structure itself is starting to crack. Around the world, trade tensions are rising, tariffs are back on the table, and cross-border commerce is slowing down. These aren't isolated events. They're warning signs of something much bigger, a coming economic downturn that could be far more destructive than 2008. Think about it. The world runs on interconnected supply chains. When tariffs and trade conflicts disrupt that flow, everything starts to seize up, from farming equipment to housing materials to industrial metals. In fact, even simple business decisions are getting delayed because no one knows what kind of economic environment they'll face next. I heard from a business owner in Australia trying to import portable chicken coops from Poland. He's literally waiting for the Supreme Court to decide on tariff rules before he can move forward. That's how fragile things have become. This kind of uncertainty doesn't just hurt small businesses, it ripples through the entire economy. When producers can't plan, they stop hiring, stop expanding, and stop investing. And once that confidence disappears, the real economy starts to contract. That's the domino effect that can trigger a global financial collapse. And make no mistake, the setup is already there. Many analysts believe the next crisis won't just mirror 2008, it'll be far worse. Back then, governments still had some room to maneuver. They could slash rates and print their way out of the storm. But now, the world is drowning in debt, interest rates are already low, and central banks have run out of tools. They've been propping up markets for too long, and now they're boxed in. In a downturn like that, we'll likely see demand for construction, housing, cars, and base metals collapse. Prices for copper, aluminum, and other industrial commodities could plunge. And here's where things get interesting. That's exactly when gold and silver will shine brightest. When confidence dies and liquidity dries up, investors don't run to stocks or real estate. They run to monetary metals. It's ironic, really. Countries like Australia are sitting on massive reserves of gold and silver, yet their economies rely more on exporting base metals that depend on economic growth. When that growth disappears, the local currency suffers, even if the nation is rich in real money, precious metals. So here's the bottom line. If you're positioning yourself for the next few years, you can't afford to think like it's 2008 again. This time, the cracks are deeper, the debt is higher, and the safety nets are gone. The illusion of control from central banks is starting to fade. And when that happens, gold and silver won't just be safe havens, they'll be lifeboats in a storm most people still refuse to see coming. Now let's talk about what's really trapping central banks, because this is where the game gets dangerous. For decades, every economic slowdown has been met with the same playbook: cut interest rates, flood the system with liquidity, and pray growth returns. But here's the harsh truth. That formula doesn't work anymore. We've reached a point where the medicine has become the poison. Today, inflation is still elevated, yet central banks are cutting rates again. They're pretending to fight inflation while quietly admitting they can't afford to stop printing money. That's insanity. Every rate cut weakens purchasing power further, driving even more inflation in the long term. And what's worse, the effects of monetary easing take time, 18 to 24 months to show up in consumer prices. So by the time central banks realize their mistake, inflation will already be roaring back even harder. This cycle of artificial stimulus and denial is why I believe we're heading towards something worse than 2008. Back then, at least the system had some balance left. Now everything is debt. Governments, corporations, households, everyone's leveraged to the edge. Central banks can't hike rates because it would bankrupt half the world, and they can't cut rates without triggering another inflation spiral. They're stuck in their own trap, and the exit doesn't exist anymore. Think about it. For years, we've heard the phrase money printing, but that's not even the right term. They don't actually print anything. They just add zeros on screens. The entire global economy now floats on digital promises. Numbers typed into existence, backed by nothing but faith. And the scariest part? Those numbers are infinite. That's why the mathematics of fiat currency guarantees failure. It's not an opinion, it's arithmetic. A debt-based system must always expand to survive. But the more it expands, the less valuable each unit becomes. Over time, every national currency collapses under its own weight. The US dollar, the euro, the yen, they're all on the same sinking ship, just sinking at different speeds. And when that happens, the only things that hold real value are assets outside the debt system, gold and silver. These metals don't rely on central banks, politicians, or algorithms. They've held value for thousands of years, through every empire's rise and fall. Fiat money is temporary. Precious metals are eternal. So when you see the Federal Reserve or the Reserve Bank of Australia slashing rates while inflation is still alive, understand that it's not policy, it's desperation. They're trying to keep the illusion of control alive just a little longer. But deep down, even they know. Once the public loses faith in paper, the only real money left will be the kind you can hold in your hand, gold and silver. As we reach the end of this discussion, let's put everything into perspective. What we're witnessing right now isn't just another market cycle. It's the slow, inevitable breakdown of a debt-based financial system that has run out of tools. Central banks have played their final cards. Rate cuts, quantitative easing, balance sheet expansion. These are all short-term fixes for a system that no longer responds to stimulus. The moment real inflation starts climbing again, their entire strategy backfires. When governments print money to solve every crisis, they're not solving anything. They're diluting the very value of that money. It's like pouring water into wine. Eventually, there's no wine left. Only a tasteless mix that looks the same, but holds no value. Fiat currencies are heading down that path right now. Whether it's the dollar, euro, or yen, every one of them is being destroyed slowly by the same disease: endless debt creation. Gold and silver, on the other hand, don't care about politics, inflation targets, or interest rates. They've survived every empire, every crash, every currency collapse in recorded history. That's why serious investors, and even central banks in the East, are quietly buying more metal than ever before. They're preparing for what's next: a global revaluation of real assets when paper money loses credibility. So if you're sitting there wondering whether now is the time to hedge, protect, or reposition, the answer is simple. Nobody can time the top or bottom perfectly. But when the system is visibly cracking, you don't wait for permission to protect yourself. Physical gold and silver aren't investments in profit. They're insurance against stupidity at the highest levels of finance. Remember, I'm not giving financial advice. I'm sharing what history already taught us. Every time governments lose control of debt, real money takes center stage again. And this time won't be different. If you've been watching till now, I want to hear your thoughts. Do you believe central banks can actually fix this? Or are we heading toward a reset where gold and silver finally reveal their true worth? Drop your opinion in the comments. I read every one of them. And if you found value in this breakdown, don't forget to hit that like button, subscribe to the channel, and turn on the bell icon so you don't miss the next update. This is Gold Rush Reporter, your source for hard truth and real analysis on gold, silver, and the collapsing global monetary system. Until next time, stay alert, stay informed, and keep stacking.